Good Monday morning, Market Chameleons, and those joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, which lost a roadway in, Dmitry Pargomatic. How you doing, D?
Good morning, Will. How are you?
Good. That was quite an explosion on 95 this weekend, huh?
Oh, yeah. Did you see the pictures?
Yeah, it's terrible.
Yeah, I don't know if people outside of Philadelphia know, but that was like, uh, you know,
Well,
pretty
it's the main corridor from the
big.
north. Well, it's 95, which is the main highway that runs north-south around the East Coast, and half of it's now gone.
They have to close down the highway
Yeah.
to repair it. It'd take a couple months. And what happened exactly?
I think it was a fuel tanker truck that was making a delivery to the fuel stations, got off the off-ramp, somehow caught on fire and stopped right under where the highway crosses the street. So it was below. So it was on fire. Eventually it blew up, and the amount of heat generated in the fire melted caused the girders to fail, basically. So that whole section of roadway, which is basically a concrete bridge, just came tumbling down.
Yeah, no, it's a disaster. I've never seen that before.
No, it's amazing.
I
mean, knock on wood. Thank God it doesn't happen. If I were a terrorist and I saw that, seems like it would be a tool that could be used in lots of places, right?
Yeah, well, I think that's why that industry is so highly regulated. Driving around fuel tanks or any type of material like that. I think it's very heavily
I hope so.
regulated, and I don't think it's that easy to even get that job because you have to go. I'm sure you have to go through other types of tests as well. From drinking to.
It's not just getting your CDL license.
Yeah. No, I think that those jobs are not that easy to get, and they're vetted and highly regulated. Yeah, I mean, this was just an accident. Obviously, this was
a freak accident. I mean, in our lifetimes, we've never seen anything like that.
Yeah.
All right, well, let's start with the disclaimer.
All right, so everyone, good morning. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
While I'm sharing my screen quickly, I wanted to make a note. Anyone joining us for the first time, Will and I, we do these shows in the morning to help answer questions you have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we provide a link to Zoom on that live chat on YouTube. Click on it, takes you over to Zoom. Once you're in there, click raise your hand. You could come on a show, ask your question live. If you prefer to type your question, you can type that question onto that live chat on YouTube. Will's watching it. He'll read them back to me. While we're waiting for more people to join us and for questions to come in, we'll take a quick look at the pre-market report, see if we could get some insights on stocks that are trading in the pre-market hours. After we do that, we'll go to the questions. Okay. Perfect. So pre-market report, these are stocks trading in pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. I see coming down to the bottom of the list, I see 71 stocks made our percentage gainers list, 37 on our percentage decliners list. So from this perspective, it looks like we're setting up for a bullish bias at the open. I'm going to scroll up here really quickly. And here we have a calendar view. So if you could go back days for the pre-market report. We're right here right now, June 12th. This is what's going on right now in the pre-market hours, kind of a top view. We have the number of stocks that are up in the pre-market hours relative to the previous day's close, stocks that are down. So we see 487 stocks trading higher, 213 trading lower. We break it down also by volume or number of shares. So there were 106 million shares traded on up volume versus 29.2 million on down volume. And if we convert those shares to dollar value, so every, stocks have different prices. So if we convert the volume to dollar value, about $2.3 billion worth of stocks trading up versus 237 million down in the pre-market. All right, so that also shows pretty good ratio that we're setting up right now with a bullish sentiment at the open.
I saw in that pre-market that the NASDAQ was down. Any news?
Yeah, did you see the news there?
I'm just looking at it. They paid a 10.5 billion cash and stock deal.
They're buying a software company, I believe.
Yeah. Have you? I mean, I've never heard of that software company. Have you?
No. That's a pretty big perk. 10.8 billion. I've read it briefly. Something with they cater to big banks selling software, I think, to meet like compliance and risk management tools. But it looks like NASDAQ is indicating that they want to diversify their revenue and not rely completely on the transaction.
Yeah, no, that's quite a dollar figure.
Yeah. So especially NASDAQ, I think themselves was $28 billion market cap. So they're paying $10 billion for a company. That's a big purchase. Another thing we could look at to get some more insights is when we look at the list below here, there are a lot of stocks in there that are small cap stocks. We have ETFs in here, leverage products, could be even a preferred stock. Pretty much anything that's listed on a major US exchange, if it's trading in pre-market hours, it can make this list. And to narrow down this list of stocks to a smaller group, we could use the filters above. And here, I'm going to do this one as an example in ETF. When you click on it, you get a drop-down menu to choose an ETF from. The top 3 are broad-based ETFs. Then you got some sector ETFs. You could do the same thing with your watch list, like right here. But I'm going to stay with this in ETF. Let's select SPY. When you click on it, the list below, I think I have to refresh my screen here because I had it up for a while. So let's see the newest list. And when you select this in ETF over here, let's put SPY and the list below. I don't know why my computer is a little slow today. Will get filtered by stocks that are holdings in the SPY ETF. And here we see 16 stocks made our percentage gainers list, 12 in the decliners. So, it's still a slightly more bullish bias than bearish from that perspective. Kind of, even, a little bit of a mixed bag, but more tilted towards the bullish side. So let me see. We could take questions now if you have them, Will. If not, I'll just continue on some conversations we had from previous week.
Yeah, nothing's popped up, D.
Okay.
I'll let you know if something comes in.
Okay. So let's see. We had a lot of questions about implied volatility. I'm sorry, I have like allergies right now. They're starting to act up.
It could be the smoke is back from the Canadian forest fires, actually.
Maybe, I don't know, but this feels more like allergies right now. When we talk about implied volatility, it's important to understand kind of, where does this number even come from? What does it mean? Because I think people go straight to trying trying to use it in a way that they've seen in places maybe that's demonstrated. A lot of times it's just like, is implied volatility high or low? And they look at implied volatility as, just like this number that exists on the market. So there's a number, implied volatility, it's trading somewhere, and is it high or low? And then they base different option strategies based on if it's high or low. And so let's move away from that and just kind of discuss, where is this number, coming from? I'm gonna bring up a paint here. People like visual, and this implied volatility. Let me see what's going on here. So implied volatility, right, it is an output from a model. That's what it is. It's an output from a model. Okay. It's not something that's traded. It's not something that is, is traded. What I mean, like a stock, right? That you could sit there and you're like, yeah, I could buy a stock or I could sell a stock, and it's this, security that I could hold, or a bond. Implied volatility is this number that you get from a model that has assumptions in it. So, and it's trying to answer something about an option. So let's take a look at a different example so we could make a comparison. Let's say I wanted to buy a house, right? And I see that, a price of a house could be, let's say 100,000, right? $100,000. So as an investor, I might think, well, what does this price imply about this house? If I'm an investor, because 100,000 is just a price, right? Just like an option, it's just a price. Like if you get an option price and you're like, it's $2, it's $3, whatever. But what does this imply? And I could run it through a model and try to figure out what this price of the house is implying based on a question that I have. Okay, so if I'm an investor, I might be looking at a house from the perspective of a cap rate, right? And a cap rate is let's say 10%. A cap rate is what do I think is a appropriate return on your dollar invested, from rent. So what is the implied rent? I want to figure out what is the implied rent on this house. So if I have a cap rate, if I'm assuming, right, that the cap rate is 10%, then the implied rent is 10,000, right? That means that if I buy this, it's implying that I could get $10,000 worth of rent per year. What if all of a sudden, I see that the sales price went up to 120,000. Now somebody's paying 120,000, and I got to assume my model has assumptions. Cap rate remains at 10%. Well, now the implied rent, right? Now the implied rent is 12,000, right? That means like that whatever it is, maybe the rental market is hotter, I could get more for my rent, and now the implied rent is 12,000. And the implied volatility kind of works the same way, where we take in the price, right? We take in the price of the option, just like the price of the house. Then we run it through a model that has assumptions. A model that has assumptions, and then we get this implied value, right? This is what implied volatility is, right? And when we look at it, you could see that this model has a lot of assumptions, just like the options pricing model. It does have a lot of assumptions. It's not like this magical, equation or formula. It has to stick to the assumptions to come up with this implied value. So what am I looking at? Well, first of all, the cap rate is an assumption, 10%, right? This is because if I change it, it changes the whole thing. And just like the option pricing model, they have it has assumptions. It has interest rates assumptions, it has dividend assumptions in there. It has they call them log normal distribution assumption, constant volatility assumption. All these, there are assumptions in there, and if those assumptions do not prove to be true, then the model is not very useful in answering the question. Okay, or if the stock doesn't behave in the way that the model assumes, then the implied volatility output is not that meaningful anymore. Okay, so it's really important to understand how to use this model, and there are different periods or different situations where the option pricing model is not an appropriate model. What about this 120,000? Well, I'm also assuming, right? So now I have all these assumptions we talked about, right? Well, I have a cap rate here. Well, the option pricing model also has assumptions, right? You have to input those assumptions. You got interest rates, dividends, in there. You got, a normal distribution, constant constant volatility. All these assumptions are in there for this model to produce an answer. Just like this cap rate. If I change this cap rate, or if I change these assumptions, my implied volatility output will change. Okay. Now let's go towards the intent. Well, what about this person paying 120,000? Right? Well, I'm assuming for my model to work, I'm assuming that the reason that they're paying there is that their intent is to rent it out, right? Is to rent it out and yield some kind of a return. That's my model's assumption, right? This is how my model's based on. So what if somebody didn't buy it? What if the market isn't buying it for different reasons? What if the market, somebody's just buying the house, they love it, and it's worth 120,000 to them, and they're going to just pay that irrelevant of the rent? Or what if they're just buying it, they want to wreck it down and build something new on it or repurpose it? Then my model, the assumption is it's not a good model to explain that price. Okay, so if I input it for 120,000 and I'm assuming that they're doing it based on yield and they're implying $12,000 rent, but if that's not really the case, then my model is just estimating this rent, but it's not really inappropriate. That's how options work as well with implied volatility. Because what are you assuming? You're assuming that buyers and sellers of options are trading volatility. right? Typing it fast. Is that right? Let's just put vol, right? Look, this is an assumption you're making when you're using the option pricing model. But that's not always the case, because when people sometimes buy options or sell options or trade options, they're not trading volatility, right? And this is the same thing going on with during earnings. When you're buying or selling options for an earnings, you're really looking at what is the earnings gap going to be, right? It's not really volatility anymore because it's not a fluctuation back and forth, or you're looking at there could be earnings that could be create an explosive move in the stock from the previous day's close to the next day's open. That's a gap. And the option pricing model doesn't assume that's going to happen, right? There's no such thing as a gap move in the option pricing model. It always assumes it's going to, remember we said it's going to move in a log normal distribution. So if you're looking at a situation and you're seeing option prices in the most likely scenario, like NFT, let's say people are looking at an option because there's an FDA about an FDA decision. Well, we know that after that news, the stock could have a really big binary. It could have a really big move, right? And then the volatility will revert to some other, normal volatility. Well, that move alone on a binary event, the option pricing model assumes that doesn't even happen. Okay, so people are going to be pricing options sometimes that are for different purposes than trading volatility. Okay, they're using options for different purpose. Okay, like a lot of folks out there, I see it, they're not trading volatility. They're buying and selling options because they think that there's a directional move, or you're selling out of the money options because you think it's not likely, that the stock will gap down to those prices and so forth. Well, then you're not even using the options to trade volatility. You're really using them for a different purpose. Just like somebody who could buy a house can use it for a much different purpose than renting it out and trying to make yield on the carry cost, right? So that's very important to understand, because if you don't understand it, you're looking at this output and the output doesn't know that you're using it wrong. Okay, and the option pricing model has no idea what you're using it for, what your strategy is, what your intent is. It doesn't know any of that. It just creates this output, and it's up to you to fully understand it. So you're using it in a practical manner, or you're just kind of like, you're referencing, but not in really even a meaningful way. So couple takeaways. Where's this implied volatility coming from? Again, it's coming from a model that's trying to answer a question, right? And it's trying to answer a question based on a lot of assumptions. And if those assumptions are incorrect, then the implied volatility output is not very useful. Okay, so we're nearing the end here. Well, if there are no questions here, I might just stop there, especially my allergies are like really acting up here.
Yeah, great job, D. We do, just a reminder, have a webinar tomorrow with Interactive Brokers at 2 p.m. Second Tuesday of every month. We do webinars with Interactive Brokers. What's the title of that one, D?
That we're going to be, I don't remember exact title, but we're going to analyze trades using, the delta gamma vega risk components.
All right. Well, that's going to be a good one for sure. And I'll put it in the chat. It's I analyzed an options trade with Dmitry Pargomatic on June 13th. So I'll put the registration link in the chat so everyone can have that. Great job as always, D.
All right. Thanks, Will. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, communities. Have a great day, D.